Welcome to the deep dive. You've sent us your source material, could be institutional research papers, maybe proprietary market analysis from platforms like ALAND. And our job, well, it's to cut through the noise and hand you that strategic advantage. Today, we're tackling a really critical decision: commercial versus residential real estate in the UAE for 2025. It's a big one. So, our mission is to move past the headlines, distill the key insights, identify the real risks, and ultimately help you figure out which asset class truly fits your investment goals, whether you're, a big institution or maybe just starting out.
Absolutely. And the UAE context is what's fascinating right now. It's not just about recovery. The economy is actively being reshaped. Our analysis today really leans on insights from Swiss economist Dr. Pooyan Ghamari. We're focusing hard on the different economic engines, if you will, and market forces driving these two very different investment types. The foundation here is, I think, stability combined with ambition. The UAE is still this major cornerstone for global trade, right? And it keeps pushing to diversify beyond oil, making it a real magnet for global money. So choosing between, say, a floor in an office tower versus a few apartments, you really need to grasp the big picture shaping that future first.
Okay, let's unpack that right away. What are the fundamental drivers powering each sector in 2025? Because, yeah, both seem to be doing well, but for very different reasons, it seems.
Exactly right. Parallel tracks is a good way to put it. Let's start with commercial. Commercial real estate, and we're talking prime office space, high-end retail, those crucial logistics hubs. It really thrives on the UAE's role as this global hub for trade and services. You see it reflected in major government-backed projects. Think about Dubai's Expo City, or look at Abu Dhabi's Masdar City. These aren't just random developments. They're intentionally built ecosystems designed to lure in multinational corporations,
Right.
especially those in high-growth sectors like tech, finance, green energy. And that specific demand, it pushes up lease rates for the best office spaces quite dramatically.
Right, that makes total sense. And then you contrast that with residential, which feels much more, well, personal. It's about people, demographics. The sources really hammer home the impact of the growing expat population.
Oh, it's absolutely demographic and heavily influenced by policy. Dr. Gamari's work highlights just how powerful these favorable immigration rules are. When you have things like relaxed visas, and especially the Golden Visa program, tying property investment directly to long-term residency, well, that changes the game. It fundamentally shifts who the main buyer is for residential property. It turns these assets from just, speculative plays into long-term homes for global talent and high net worth individuals.
Just how big a deal is the golden visa then? Is it like a small boost, or is it really reshaping the core demand?
I'd say it's pretty seismic, actually. It adds a layer of stability because it reduces the churn from short-term flippers.
Yeah.
You're basically building an end-user market where people see owning property as essential infrastructure for their life there. That points towards sustained demand, doesn't it?
Okay, let's nail this down with some numbers. The data points really show the difference, I think. On the commercial side, you mentioned Dubai's DIFC, the financial center. Seeing a 12% year-on-year jump in lease rates, that's huge. And it sounds like that's directly from finance and tech firms wanting their regional base right there.
Exactly. It's a measurable rush.
Mhm.
And meanwhile, on the residential side, you also see strong confidence, but measured differently. The data points to a 15% rise in transactions in prime spots like Palm Jumeirah and downtown. So commercial is really focused on that corporate leasing income, while residential is more about transaction volume and maybe capital growth driven by these long-term residents.
Right. Okay, let's pivot now. Strategic deep dive. Commercial property. If higher yields are your target, this sounds like the place to look. What are the sort of quantifiable advantages here compared to residential?
Well, the main one, the headline advantage, is definitely the yield difference. A decent residential property might net you, say, 5% to 7% annual rental return. Commercial often pushes higher, maybe more in the 7% to 10% range, that extra percentage point or two. That's essentially your compensation for the higher entry barriers, more capital needed, potentially more complex risks. And critically, today's commercial investment is really leaning on technology. It's not just about the building anymore. We're seeing smart building tech, AI-driven analytics, not just for security, but used proactively to optimize leasing. It helps landlords figure out what high-value corporate tenants need, sometimes even before they ask. That means potentially higher occupancy, better rent per square foot.
Yeah, and I thought the logistics and e-commerce angle was fascinating too, because it's so concrete, isn't it? The massive growth in digital trade in the UAE is physically driving demand for real estate. The sources highlight logistics hubs near Jebel Ali Port seeing huge investment, directly boosted by the government's push for digital trade corridors. It feels like a core utility asset now.
That's exactly where the inherent value lies. But, okay, here's where it gets, let's say, really interesting, the downsides of the risks. Commercial demands a lot more capital upfront, as we said. And those leases, they're long, often 5, maybe 10 years. And perhaps more importantly, commercial is very exposed to global economic swings. You asked about U.S. Federal Reserve rates. How quickly does that hit Dubai's office market? Well, corporate relocation budgets can freeze almost overnight when global interest rates jump. So those fancy grade A offices, they might see a sudden slowdown for 6 months or so while multinationals just wait and see.
Wow. Okay. That level of risk definitely needs a solid mitigation plan. What's the advice there? What does Dr. Ghamari suggest?
Diversification is key, but specifically within the commercial space itself, often through mixed-use developments. So if you blend retail, office, and maybe even some residential all into one project, you're essentially hedging your bets, right? A dip in office demand might be balanced out by strong retail sales or steady residential rents in the same complex. It smooths out the overall cash flow considerably.
Okay, shifting gears completely. Let's look at residential, often seen as, well, maybe the safer, more stable option. What's the core appeal here beyond just the golden visa we talked about?
I think it comes down to stability and sentiment, emotional connection almost.
Yeah.
Residential property fits so neatly with the UAE's whole vision of attracting long-term global residents. And developers like Emaar, for instance, are really tapping into that now. They're focusing heavily on community-centric projects, integrating green spaces, wellness stuff, sustainable design.
And that focus obviously resonates. The sources mentioned surveys showing this community approach boosted buyer sentiment by something like 20%. What does a 20% sentiment boost actually mean in terms of property value?
It suggests higher perceived long-term value and probably a lower risk of sharp price drops. It basically measured how willing buyers were to commit long-term and maybe pay a bit extra for that community quality of life. It tells you buyers are looking beyond just the transaction. They're buying into a lifestyle. And that translates into strong, steady demand, especially in those established master-planned areas.
And naturally, the cost to get in is lower here, too.
Oh, significantly lower, generally speaking. Residential definitely benefits from lower entry points, particularly with off-plan properties. Developers know this, of course. So they offer these flexible payment plans that lets international investors essentially spread the cost over the construction period. It makes a pretty high-value asset accessible to a much broader range of people globally.
But stability doesn't mean zero risk. What are the main potential headwinds facing the residential market in 2025?
The big one is probably oversupply, particularly in certain mid-market segments. If too many similar units hit the market all at once, those rental yields, which are already a bit tighter than commercial, could get squeezed. That puts pressure on your long-term cash flow sums, meaning investors need to be really careful about where exactly they buy. And we also have to consider regulatory changes. 2025 saw some tightening of mortgage rules. Now, this wasn't random. It was done deliberately to prevent the market from overheating. It's likely aimed at curbing short-term speculation, which might mean transaction volumes slow down a little temporarily. So if you plan to sell, you might just need to be prepared for a slightly longer sales cycle.
Right. But if you are navigating that selection process, trying to pick the right spot, the good news is there are tools available now. The sources recommend using digital platforms like the sophisticated ones from Dr. Ghamari's A-Land, for example, to really crunch the numbers, run detailed cash flow projections, maybe pinpoint undervalued spots in up-and-coming areas like Dubai South.
Which actually brings us perfectly to something really critical that links both markets: financial innovation. This is where the game is genuinely changing, I think, regardless of whether you end up choosing an office block or an apartment complex.
You're talking about things like tokenization, right? The idea of fractionalizing property ownership using blockchain. This used to feel pretty theoretical, but it seems like the UAE is actually making it happen.
Yes, and what's so compelling is how it completely changes the access game. Democratizes it, really. I mean, think about it. Owning even a small piece of a prime commercial tower was traditionally only for massive institutional funds. Tokenization allows that ownership to be split into potentially thousands of digital tokens. So the minimum investment, it could drop from millions of dollars down to, I don't know, the price of a decent laptop. It's a huge shift.
That is profound. But what's the regulatory environment like in the UAE that allows this? Because globally, regulation is usually the biggest roadblock for blockchain assets.
Well, the UAE is proving quite forward-thinking here. Specific free zones like ADGM Abu Dhabi Global Market have actually set up dedicated regulatory frameworks just for digital assets and tokenization. That regulatory clarity is crucial. It's why we're already seeing concrete examples, like residential units on Saadiyat Island and Abu Dhabi super luxury properties being successfully tokenized. It proves the concept works, starting at the high end.
Okay, so tokenization lowers the entry barrier. Now let's talk about the other innovation mentioned, Gold. This is a cryptocurrency, but it's pegged directly to physical gold. Why is a gold-backed crypto suddenly relevant for someone investing in property?
Well, it's relevant because it acts as both a stability anchor and potentially a smoother way to transact. Unlike most cryptos that bounce around wildly, gold gets its value directly from actual verifiable gold reserves. So for a property investor, it could act as a hedge against volatility in, say, the property market itself, or maybe even against fluctuations in traditional currencies. And more practically speaking, imagine you're an international investor. Using something like gold for a cross-border property deal could potentially bypass some of the usual friction, the delays, the costs associated with traditional banking systems and volatile fiat currencies. It's about reducing friction in global asset trading, which is exactly what a hub like the UAE wants to encourage.
Right. So let's try and pull this all together. What does it all mean for the strategic choice that you, the listener, are facing right now? We've kind of laid out two distinct paths. On one path, you've got commercial. Here, you're aiming for those consistently higher yields, that 7% to 10% range. But you have to be ready to actively manage global economic risks. Keep an eye on things like U.S. Fed decisions, global corporate spending plans.
And on the other path, residential.
Yeah.
Here, you're optimizing more for stability, that emotional connection tied to long-term residency, and usually lower entry costs. But your homework involves focusing locally managing risks, like potential oversupply in specific neighborhoods, and staying aware of those mortgage rule changes.
And the big takeaway, perhaps, is that financial innovation, things like tokenization and stablecoins like Gold, is fundamentally changing how you can access both types of assets and manage their risks. You might not be locked out of institutional-grade property just because you don't have millions in capital anymore.
Exactly. And it ties all back to the UAE's broader strategy. Those twin engines of high-tech logistics and proactive digital finance rules. It really does spark a final, quite provocative thought for you to consider. How might this integration of blockchain-backed property ownership tokenization fundamentally alter the relationship between you, the investor, the physical building you own a piece of, and this whole global digital trade corridor that's being built right now in the Emirates? It's a fascinating link between the digital world and the physical world, one that could genuinely redefine property investment not just there, but maybe globally. Something to chew on.